Vikas Khemani joined just now. Let's connect with him to understand that what should one do, how should one read into the current global turmoil, if I may use the word. Vikas, good morning. Thank you for joining us. A lot of parallels have been drawn that this is not like 2008 exactly, but this is similar to in terms of the collateral damage it eventually will have on asset prices. Do you think we are in repeat of not the same magnitude, but a little bit of the same because of the because of the problem in US banks?
Hi, Nikunj. Good morning. See, we all know that while a lot of things remain same, and yet there are some things are different in every sort of incident and cycle. Of course, global financial crisis happened because of the excesses in the banking system, especially on the levers front, which I think is different than this time because this time around there is not a lot of leverage in the system. Of course, banking by design is supposed to lend and take the money from the depositors. This time around, it is about the losses, mark-to-market losses sitting on the books of the balance sheet. And larger banks are still, well managed or well, reasonably solid as it appears from till now. Unless some surprise is waiting. But looks like that leverage this time around in the banking system is far, far lower than what it was in 2008 crisis. And another thing is that right now, with a smaller event, the regulators and government has come into action to kind of rescue these banks and reduce the contagion impact of this on a wider economy. So I'm assuming that unlikely that it will have a wider impact, but you can't wish away the pain when the interest rates are raised so sharply in such a short period of time. The pain is bound to happen. It is bound to reflect in some way or other. Still we might have some pains coming in the pension funds and endowment funds because they also are sitting on large amount of mark-to-market losses. The only thing is that since they don't have a liability immediately staring on you, it can continue for long. So while one knows that there's a hole there, but one does not know how whether it will come or how it will come. So I think these are very complex interlinkages. But from the outside, it looks like that unlikely it will impact, given the fact that everybody around is in action to make sure that there's no contagion. Should be contained according to me here. But we'll have to keep watching, keep evolving in the situation.
Let me look at a recent example. When there was the panic in Adani group of stocks, lenders also fell. In hindsight, if you bought the lenders to the Adani group of stocks, Adani group of companies today, that turned out to be a good, solid financial decision. So 3 months from now, 2 months from now, when we will look back and analyze March of 2023, and for those who bought because of the global SVP fear, will they be rewarded for their prudence?
So it was very, very wise point you made. See, whatever is happening elsewhere in the world right now, good part is that there's no economic impact or there's very minor or almost negligible economic impact happening on India as an economy. Our interlinkages on that part of the world is very limited, only to the extent. We don't borrow significant amount of capital from them. Whatever money is coming in form of equity. So there's very limited linkages with the financial markets of US and India to that extent, or banking system of US and India. So I don't see any reason why Indian economy will get impacted with whatever is happening in the rest of the world. And to that extent, I completely agree with you that any such corrections, are seen or should be seen as an opportunity to invest. And in 6 months, whether it is 3 months, 6 months, nobody knows. But definitely, these are very attractive points. India's story continues to remain intact. Our interest rates are not in a dangerous territory. In fact, as inflation settles down, which I think is a matter of time, whether it is 3 months or 4 months, I think we have already seen the peak, and slowly you start seeing only coming down. There could be case made for Indian interest rates coming down, whether it is again 6 months, 12 months, I don't know. But Indian economy is on a solid path. And slow down of 1 or 2 quarters always happens, but generally speaking, directionally, I don't see any reason, and hence any such price correction because of problem elsewhere. Just like you mentioned in case of Adani, if you can keep your emotions aside and know that the exposure towards of banks was against the collateralized assets in case of Adani, and people bought that. So same thing would happen, that our interlinkages of the Indian economy with US economy is limited. You can keep your emotions aside and buy that. So I completely agree with you on that point.
IT take a hit. Now, Persistent came out and said, look, we got a little exposure. We also heard from other IT companies where they've said that so far there is no problem in terms of a direct correlation with the SVP bank. But when you see a problem like this, the sector P multiples rarely expands, and on top of that, there is a US slowdown. On top of that, there is a layoff which is happening in the big tech funds. Do you think IT has peaked out for a long, long time now?
Not really. I think if you see IT demand is only, if you ask me, getting better. Now, again, there are two perspectives to look at. One is the medium term to long term, or secondly, the short term, immediate term, right? I mean, whole of last year, everybody called out that IT demand will collapse, but we did not see that happening at all in the order wins of any of the large or mid, any company for that matter. We continue to see order book getting accreted better. Secondly, I think see, this time around IT spend is very discretionary. Yesterday, I think LTI Mindtree analyst meet also they kind of alluded to similar things that structural demand is very very robust, right? Uh, Other thing which I think today when somebody is giving an order to any IT company, he is doing only bare minimum what is essential for his survival or or operational purpose, right? The developmental expenditure on IT is yet to come, which, in my opinion, will start happening once the US economy stabilizes or interest rates starts coming down. So, if you ask me, IT could be a very interesting play on interest rates coming down in US. Whether it happens 6 months, 12 months down the line, I don't know. And meanwhile, these companies are generating reasonably good amount of growth and cash flows. Now, these one or two clients going away, getting bankrupt, those events happen in every business, will continue to happen. But I don't see a reason why one should get significantly worried, especially when IT companies are delivering reasonably good growth and attrition rate coming down, helping them, right? I mean, whatever is firing happening in the new tech is helping IT companies to recover from the attrition which they faced, year and a half ago in a major way. So to that extent, it helps them.
But Vikas, I mean, truth be told, we're down a good 10%, right, from the top on the index. What as a strategy is it that you're doing in your funds at Carnelian? Have you been a buyer in the recent decline or the consolidation as well in the market previously?
So I think again we have to see it in the perspective. Please understand, markets are down only 10% of the peak. But in this period, what has happened? In this period, we have had such a sharpest rise in the interest rates. We have seen inflation shooting through the roof. Global situation completely changing. We just came out of a major, in the textbook, whatever you read, major shocks to the global economic growth. We are all seeing that. So in that context, also, if we are down only 10% of the peak, it, in my opinion, tells you a lot of resilience of the Indian economy, right? And it has outperformed most or all markets, across the board. So one is to look at on absolute basis, other is to look at what's happening elsewhere because market operates in a relative scenario, right? Doesn't operate in isolation. So and these kind of corrections only do provide, like I was saying, that great opportunity as long as you believe that Indian story continues to remain robust, Indian corporate earning cycle is robust, Indian balance sheets are robust, and if you see Indian balance sheets are fairly robust today. Our banking system, our household savings, a household leverage. I mean, we are one of the most under leveraged country around the globe. So yet there are so many investment cycles just kicked in. Consumption cycle has not even started according to me. So we are in a we as an economy has lot of drivers of growth, and whatever is happening rest of the world is in some sense certainly benefiting India. So I will say these are the corrections which are great opportunities to deploy capital, and that's what we've been doing. In fact, we are calling some of our clients saying that to deploy money. If you want to deploy more money, this is the time. I mean, that's our view, and we continue to remain. We may be wrong in short term, I don't know, but I am reasonably sure these periods, when you look at, like Nikunj was saying, year downline, 2 year downline, are great opportunities, and those prices won't probably come back.
Where, Vikas, are you telling them to deploy money then if you believe that there is this opportunity?
No, absolutely, absolutely.
Where is it, I'm asking, that you're telling them to
Okay.
deploy? Yeah.
Oh, sure, sure. Sorry. So I think clearly, in my opinion, banking will lead the rally even when it recovers from here. Because that's a large sector. Sector is in great shape. It's growing well. Profits. I mean, if you look at credit growth has just picked up, and it just continues to generally, sort of remains robust for some time. So I think, at least I see next, you know, 18 to 24 months, this sector remaining pretty decent, and that would lead the rally. I'm quite optimistic and positive on the manufacturing story. We are seeing companies changing their scale, and that kind of uplift happening in many manufacturing spaces across the board. And one can look at companies, again, this is very diversified way, but I think some of the great opportunities are there. Stock prices have corrected 40-50% in many cases, and those are very, very interesting opportunities, according to me, to have a look at it. IT, like I was saying, we continue to remain reasonably robust. Industrials, capital goods cycle again looks pretty decent. So I think India has a very wide, if you ask me, playbook. And some of these three, four sectors, we are very, very sort of convinced about it. Only thing we are right now not buying or not very, this thing is, one is consumer durables or consumer discretionary, because that I think is still some time away recovery, and maybe to some extent commodities and real estate kind of players we are avoiding. But rest structural stories where there's a long runway of growth ahead of us, we are kind of right now buying and nibbling and advising same to people.
Vikas, great to have you on the show. Thank you so much for taking the time out and joining in today with your thoughts on the markets.
Thank you very much.
Let's just revisit